Gather round, children, because I'm about to spit some hot fire of truth at you.
Welcome, class, to Accounting 221. My name is Cathy West, and I'm going to be teaching you this semester. First things first, always remember assets equal claims.
Cathy?
Yes,
Cathy,
Jenna?
what are claims?
Claims include liabilities and owner's equity. Some examples of assets. We have cash, land, equipment, anything essentially that a company has.
Ew, go away.
So the first thing you're going to find is the income statement. What you're looking to find in the end is the net income. Does anybody know what goes into net income? I'll take that as a no. So, net income is revenue minus expenses. Does anyone know what revenue is? Revenue is money that a company earns by providing customers with goods and services. Expenses is the money that that company spends in order to provide those customers with goods and services.
Cathy, I have a question.
Yes, Jenna?
Would dividends be an expense? Because I just don't know if they're the same thing.
Well, that brings us to our iClicker question. Are dividends an example of an expense? A, yes. B, no. So 99% of you said no, and 1% of you said yes. Well, I wish more of you had answered B, because no, dividends are not an expense.
I seriously need to go to sleep now.
So the next thing I want to go over is temporary accounts. Temporary accounts are the accounts that you close out at the end of each accounting period. Does anyone know what an example of a temporary account would be? Okay, well, let's remember the acronym RED. Does anyone know what RED could possibly stand for from everything that we've learned so far this semester?
Red means stop!
So obviously that is not correct, but if we remember, R is revenue, E is expenses, and D is dividends. Revenue, expenses, and dividends.
I think I'm having a heart attack. I feel like it's going like this.
The matching concept means that you take the revenue and your expenses and you record them in the same time period that they occurred.
I just don't understand.
So when Bill Cosby buys you all that steak and lobster that you enjoy eating for Halloween dinner, he needs to make sure to record it when he buys it, not when you're stuffing your faces with it on Halloween. Because the first income statement just wasn't confusing enough, here's another one, the multi-step income statement. Now, to get the net income from the multi-step income statement, what you're going to do is you're going to take your sales and you're going to minus your COGS. COGS stands for cost of goods sold. That is the units you sell times how much you purchase them for. That'll give you the gross margin. When you minus the operating expense from the gross margin, you get your net income. Any questions?
Oh my god.
So, anyways, LIFO and FIFO. LIFO means last in, first out, and FIFO means first in, first out. For example, if you're working at a Bed Bath & Beyond and you have a bunch of mirrors, the last thing you get in, say, December as opposed to January is what you sell first. Unless, if you're working in something like a restaurant, the first thing you get in, such as,
Cathy, are you okay?
I think my water just broke. Alright, guys, finals canceled. Everyone gets A's.
Okay, bye. Bye, Spider-Man. See you next week.